Hey, what's going on, everybody? Today I want to talk to you about this news article in Forbes. FHA home loans will save borrowers an average of $800 a year starting in March. Here's who qualifies. So, to give you a little backstory, I am no longer an NMLS mortgage licensed mortgage broker. However, I was for several years, and I know a thing or two about money. I know a thing or two about banks and wholesale lendings, but I'm not giving anybody financial advice or mortgage advice. I'm not going to talk about interest rates, none of that. But you might need somebody to interpret this, and that person might not even be me. Okay, so let me just tell you basically what this FHA mortgage insurance reduction means, how you might be able to interpret it. Because see, there's a chance to save up to $1,500 annually, right? So, MIP has gone from 0.85% to 0.55% of the loan amount. MIP is required. So let's go into ChatGPT and let's just say, how on a $100,000 loan that an FHA loan, how is mortgage insurance calculated? For FHA loan, the mortgage insurance is calculated based on the initial loan amount, the long term, and the loan to value. The LTV is a ratio compared to the appraised value. Upfront mortgage and premium. This is a one-time fee that's typically added to the loan amount. The upfront mortgage insurance premium rate for most FHA loans is 1.75%. Annual mortgage insurance premium. This is the monthly fee that's added to your mortgage payment. The amount depends on the LTV ratio. For FHA loans with terms of greater than 15 years and an LTV of less than 95, the MIP rate is 0.80. For loans of LTV greater than 95%, the MIP is 0.85 of the loan amount per year. Okay, so I guess the 0.85 that they were referencing to probably sensationalize the story, that's for people who only put 5% down. On an FHA loan, I'm pretty sure, and don't quote me on this, you don't have to put 3.5% down. So, for example, if you have a $100,000 loan with a 30-year mortgage and LTV ratio of 95, your upfront mortgage insurance premium was $1,750, which you pay at closing. You pay the day of closing, which would be added on to your loan amount, and your annual MIP would have been $800. I don't know if that's actually right? Oh no, it would have been $800, right? So in this new proposal, now that we've gone down, oh god, they're mad at the ad blocker. It's going down to from 0.85 to 0.55. Okay, so let's go back and do that same calculation. 100 times 0.55 obviously is now how much was that number? That number was 550. So now we're at 550, 550 divided by 12. $45 a month for your mortgage insurance premium. Now here's what I'm curious about. I'm curious if you need to refinance your loan to get that. Whether or not that just changes, right? Because sometimes back in my day when I was young, mortgage insurance stayed for the life of the loan, and then they changed it. And then they say, well, no, your mortgage insurance is going to fall off around like 8-year XYZ, But, as it should, right? Because mortgage insurance, as your balance pays down, the loan gets less risky, right? So, how much will borrowers save? Detroit. Further reductions. See, look at this. Borrowers who already have FHA loans won't qualify for this discount. In other words, this reduction is not retroactive. However, However, let me tell you a little secret. There is something called, and you guys are not going to do this because interest rates have gone up. What if interest rates go down? There's something called an FHA. What is an FHA? Streamline refinance. An FHA streamline refinance is a simple process to refinance an existing loan into a new FHA loan with a lower interest rate and or a shorter loan term. It's called a streamline refinance because the process is designed to be easier and faster than a traditional refinance. And to be eligible for an FHA streamline, the following requirements must be met. The borrower must have made on-time FHA loan payments for the last 12 months. The refinance must lower the borrower's monthly interest in payments or convert an adjustable rate mortgage into a fixed. Right, so they used to call that where the price would go up something called churning. That's not, they don't allow that anymore. The new loan amount cannot exceed the outstanding principal balance of the existing loan. The borrower must have a credit score of at least 580. The streamlined refinance process requires less documents than the traditional refinance, and there may be a reduced or no appraisal requirements. It doesn't allow people to take money out of it. Yeah. So, and you know what else you don't have to do is you don't have to re-verify income. That's something that they're not mentioned here. At least back when I did it, you didn't have to re-verify your income. So you might have you might have been paying like a 6%, and interest rates went down to 3%, and like maybe your your financial situation changed. I think you can refinance this without talking about your job or anything like that, because they've already assumed that there's no change in risk, by lowering someone's interest rate. You're just making it easier for them to pay. So anyway, that's all I got for you for today. That's the information on the new mortgage insurance premium reduction for FHA loans. Thank you.